When did you start investing into ETFs? For me, that is about 20 years ago when I started with those exchange traded funds, really starting out very basic and understanding with those ETFs how to invest and where to invest. Up until that point, I had been using mutual funds, which were very expensive. I seen monthly fees, I seen annual fees, I seen management fees. There were so many fees associated with it. It was really disheartening when it comes to investing. Now, according to an annual report by NASDAQ, millennials and Gen Zers are the two most likely to invest in ETFs, which, if you know, and if you followed any of my videos, ETFs are the one and only thing that I invest in. Looking at 81% of millennials, 75% of Gen Zers are invested and will invest into ETFs, which I know is really a game changer. When you look at the current growth of retail ETFs, it is kind of crazy. They are not going away and they've only gained in popularity in the last couple of years. So why ETFs? So when it comes to ETFs listed on the US exchange, it has hit a record-breaking 900 billion in inflows with 600 ETFs launching this year alone, according to ETF.com. Now, ETF.com, of course, is a site that I've used for a lot of different things, including comparisons between different ETFs, but we're talking $900 billion in here. It has grown in popularity. It has grown in really overall and generally in part because of the lower fee structure, which was killing me when I was invested in mutual funds. They are very costly. And of course, there is a big tax benefit when it comes to those ETFs versus in comparison to the mutual funds. But if you're old school Dave Ramsey, he still sells those mutual funds, but it seems like the managed accounts are slowly going away because they're easier to buy, they're easier to sell with ETFs. Now, mutual funds, you can only trade once a day. That is at the close of business. For a majority of ETFs, you can buy and sell them whenever you want to. If you're changing positions, it is a lot different, the structure itself, than when it comes to mutual funds. If you're an active investor, and again, you want to make some of those changes or make some adjustments, the mutual funds won't process in real time. You'll have to wait till after the market closes to go ahead and make those adjustments. Now, also, when you look at index funds, they have a 0.44 average annual fee. That is right. You are talking less than 0.5% when it comes to an annual fee. When you start looking at mutual funds, it is double. It is a 0.88 fee that you're seeing on an annual basis. And of course, similar active ETFs carry a 0.63 fee versus over 1% for an actively managed mutual fund, which we know a lot of those, even thinking of my S&P 500 fund with Vanguard, there is a version that is actively managed that is actually a mutual fund version. They call them, I believe it is Admiral shares when it comes to Vanguard, but you can get the exact same thing in a managed version. But if you followed Warren Buffett, if you followed some of the greats, majority of financial advisors, even building up those mutual funds, managing those mutual funds, cannot and do not beat the ETFs or beat the index themselves, the market itself. And when you start going out, 30, 40 years, less than, or excuse me, 90% of active investors or active traders can beat the index itself. Now, of course, as ETFs, the big thing with this is the capital gains tax. When you see the difference is the tax efficiency. Younger investors, really smart, a lot more well-researched, well-read. Starting in there are no surprises. So what can we look for in ETFs? First one, research what you have exposure to. There are 3,800 US listed ETFs as it sits today, and they are super transparent. This is something, again, when it comes to the nuts and bolts of investing, when you start looking at calls, inputs, and options and everything else, it can be super confusing, even for someone who has studied it for a while. When you start looking and breaking down ETFs, their disclosings, and their holdings are very transparent when you can see exactly what you're putting into, whether it is a different sector, what companies are in, what industries, what risk you're exposed to. ETF issuers website, just like we've seen with Vanguard, makes it, again, super transparent when it comes to ETF. So if a fund says international, if it says, IT, informational technology, you can kind of break down exactly what it is, but you can look at international funds. You can see what countries they fall into, what classifications the fund focuses on, exactly how it's built. You can drill down in those ETFs and find exactly what you're investing in, which, like I've said before, and it is a rule, that is number one when it comes to investing. You have to know what you're investing into. If you don't understand ETFs, if you don't understand mutual funds, do your research, do all of your own research, know exactly what you're putting your money into, even looking at some of the companies you're putting it into. And of course, when it comes to cryptocurrency or anything like that, know exactly what you're putting your money into. So the second take note is the wash sale rules. This again is the really big difference when it comes to ETFs and why I love them. Be mindful about the so-called wash sale rule. What this means is that writing off losses and then buying an identical security within 30 days after the sale will be a wash. So if some people are selling these to go ahead and get a tax write-off, it is not as easy as we think when it comes to ETFs. If you sell an ETF at a loss and you buy it back with a similar one in that 30-day window, you will not get the tax benefit. And some people do this when it comes to tax loss harvesting. Overall, it's pretty interesting to see, but of course you can get around this. You just have to be careful how you handle it. And if you're looking to do this and really adding to the cost basis or taking losses to offset your tax basis, definitely work with an absolute professional when it comes to getting that tax wash. Now, when it comes to ETFs in the general, when it comes to Warren Buffett and the S&P 500, I invest in the VOO. That is the Vanguard S&P 500 Index Fund. This is one that Warren Buffett was saying 90% of your portfolio, that's right, 90% of your portfolio should just be in an index fund like the S&P 500. And of course, when you think of the longevity, he has been betting on it and he has been doing incredibly, incredibly well. Even if you look at the fund this year, you're up almost 30% in the last 12 months. That is huge. I know it's not traditional and it's not going to be every year that we're seeing it, but when you start looking at the average of something like that S&P 500 fund, where you can hold that ETF, you can put money into that ETF on a consistent basis. It is going to grow. It is an index that is market cap weighted, meaning you're going to have the most exposure into the high tech sector. So we're looking at your Apples, your Google, Nvidia, a lot of those really large mega cap tech companies are going to be the majority of the purchase when you're getting into the S&P 500, but that is by design. That is the market, that is the industry. When you start looking at the index is rebalanced on a quarterly basis, but when you start thinking of overall investing, it is super easy to go ahead and invest in something like the S&P 500 index and then just set it and forget it. Now, for me personally, I do this and I build a 3-fund ETF portfolio. I've done this for an incredible long time, honestly. When you look back about 10 years, I've been doing the same thing. So I invest in something that is just a core ETF, which of course is going to be our S&P 500 index. I invest in something that is going to be a growth, like the VUG, the Vanguard Really Growth Fund, getting a lot more exposure to the tech side. Now, between both of those, having the tech side, having the exposure to that S&P 500, I know there's an overlap, and again, that is by design. And the final one of the 3 ETF portfolio that I put it into is something that is going to produce income, that is going to be something that does produce dividends, and the dividends are going to be reinvested right in back into the portfolio, meaning that if anything's underperforming, it is going to invest it right back in there, picking something like the HD, which is something that I love and I personally invest in when it comes to investing. And again, very basic overall portfolio. Definitely want to break out and talk about these ETFs because a lot of people have a lot of questions, and ETFs are the only way that I invest. I do not buy and I do not own any individual stocks in their entirety. All right, guys, so that's going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video.